What's up, everybody? Michael Silva here. So picture this right over here. Energy stocks. They've been on an explosive move, outpacing all other sectors since June and reaching record highs. The energy surge might not be all sunshine and rainbows for the broader markets. Are you intrigued yet? Well, in today's Stock Market Brief Show, we're going to be showing you the data, the charts, and the analysis that you need to understand the exciting and potentially worrisome connection between rising oil, energy prices, and the stock market. Make sure to hit that subscribe button and smash the like if you enjoy technical analysis and intermarket analysis. Let's get into today's show. Welcome back, everybody. Yes, tomorrow we get another big macro report, the inflation data, 1 hour before the market opens up, and that's going to include core inflation month over month, inflation rate month over month. We're going to get also year over year numbers for inflation and core inflation as well. Like I said, 1 hour before the market opens up. If you stay to watch this video, we're going to show you what the market's anticipating as far as risk going into tomorrow's trading session. Now, as we look at the core inflation, which excludes volatile prices such as food and energy, you can see this has been declining since 2022. Going into tomorrow's report, the last report was 4.7%. Consensus, this report is 4.3%, so it is saying that, hey, we can see this potentially decline. However, if we look at the United States inflation rate that includes volatile assets, the last report started to move higher. We got a 3.2 reading. Now, consensus going into tomorrow's report is 3.6. So are we going to, the consensus is basically telling us that it's going to uptick more. Now, remember, this includes food, energy, which we all know are a big impact on everyday consumers. If we take a look at something like the price of oil, oil has been rising since July in a very rapid fashion. We saw this big spike up. We had that golden crossover as prices pulling down, and we had an explosive move since that point. In recent trading days, we've been consolidating sideways, and today showed no mercy, up 1.78%. Now, as oil prices rise, there's a typically strong correlation to energy stocks, and the energy sector, XLE is the proxy we're using. It's a spider ETF, blah-de-da-de-da, recently hit an all-time high. It's actually up on the month 4.7%. This is a chart dating back to the 1999, way back when. And you can see the correlation between oil, boom, and energy. I'm just taking like a 5-year chart or so, going back to 2019, and I apply a correlation down here for 90 days. And what you'll notice here is there is, right now we're getting a reading at 0.95. So there is almost a 1-for-1 correlation here, and very sparingly does it see it drop into a negative or no correlative state from a 90-day perspective. So yeah, if oil rises, it's typically energy stocks are too. Now, as we've previously stated, consensus is saying, hey, we think that actually inflation is going to go higher. Are they coming in under? Are they coming in over? Well, I don't know yet. We have to wait for that report. But what is interesting here to note is that we're seeing the energy breakout. We're seeing oil break out. And if you apply the 10-year yield, right, this is basically saying that it is inflationary. You look at the 10-year yield and energy. So we have two charts overlaying each other on a weekly time frame dating back to 2014. And what you'll notice here is the 10-year yield in black. Well, when it rises, you typically have energy stocks rise too, right? When you see the 10-year yield fall, you typically see energy stocks fall too. And you have a very strong correlative chart since the big breakdown over here in 2019. Since that point, we've been seeing them move almost hand in hand, letting us know that when oil rises, energy stocks typically rise, and yields, bond yields, typically go alongside with that. Now, what does that mean for the markets? Well, take a look over here at some relative strength lines. XLK, which is technology over SPY. So when this line goes up, that means technology stocks are outperforming the S&P 500. And down here is XLE over SPY, which is energy stocks, right? Energy stocks, when this line goes up, it means energy stocks are outperforming the SPY. Up top, we have the 10-year yield by itself. And what do you notice? Well, when the 10-year yield is falling, like so over here, when rates are coming down, what do you notice technology stocks doing relative to the S&P 500? It typically an environment where technology stocks do good. Well, when things start going up, well, what happens to the relative strength here? It starts kind of, going, well, right there, it's going sideways to basically to down, right? So you can see some higher highs, some lower lows, some lower highs, some lower lows, and so forth. Now, as we see it move up at a rapid rate of change, what do you see over here take place between the relative strength line? You see it coming back down. And then when you see this drop again, you see this uptick. And now in recent trading days and recent weeks, we saw this move up and we see price kind of starting to stall out. So when the 10-year yield goes down, right, it's typically beneficial for technology relative to SPY. However, what you'll notice down here, boom, is XLE relative to SPY. It moves pretty much in hand-for-hand correlation. So when this goes down, this is going down. When this is going up, this is going up. When this is going up, this is going up, okay? So that is a very strong correlated state. Now, why is this bad for the markets? Well, as we know, rising oil has contributed to some massive crises and then also recession. So this, I'm looking at a 12-month chart. So basically a year rate of change over here. This is a monthly chart, year rate of change, 12 period. And what you'll notice is when we get a big rapid spike in the rate of change of oil prices, it has started the 1987 crash, the 1990 crash, dot-com crash, the financial crisis, even the 2022 bear market, and we're starting to just see it uptick again, right? We're starting to see a big rapid rise in the price of oil, showing us that, hey, rising oil prices, it's not good for, most stocks. It's beneficial for energy stocks, which we're seeing. What does that mean for the S&P 500? Well, if we're taking a look at the S&P 500, which is down here, and you're looking at the ratio of XLE relative to SPY, which we previously just showed on this chart, what you'll notice here is as the ratio is rising, boom, this is in 2022, the start of 2022, what is the S&P 500 doing? Boom, it's starting to go down. So when energy stocks outperform the SPY, it's not typically good for the overall market, right? We already talked about a lot of different intermarket correlations. And as of we stand right here, we're starting to see the relative strength start to pick up some pace, which is putting pressure currently on the S&P 500. You can go back to other periods in time. For example, the great financial crisis or right before it, what happened to this ratio? We saw a huge move in XLE relative to SPY, which contributed to, obviously, what took place there in the great financial crisis. Even over here, going into 2011, we saw a big spike, and we saw some big market turbulence there too as well. So what does this mean? It means that when oil goes up, it's going to be an important asset to watch. It typically means that you'll get energy stocks to outperform, but it also means that rates can stay higher for longer, which the Fed has already stated that they are doing, and we're seeing that 10-year yield rise. So it's just not a good environment for overall stocks unless if we start seeing the 10-year yield back off. Now, going into tomorrow's trading session, what are the markets pricing in as far as risk? You can screenshot this. You can put the levels on your chart. Here are the products that I track and I share with my Discord, right? We have SPX, ES, and Q. Ready? SPY, Qs, and IWM. And then their daily expected moves are right here. So typically, we're in the 2s for the daily expected moves, but because going into an event that has typically more volatility, it can, create a throttle or a gas pedal of volatility. We're getting it in the 30s for the SPX, which means what? It means the market is saying, hey, our risk range going into tomorrow is plus or minus $30. Okay, that's what it is. And if you look at this in terms of a distribution curve, 68% of the time we finish within that range. So these are the upper levels, if you want to just mark them on your chart, the lower levels on your chart. And then I also include the 2 sigma levels. The 2 sigma levels can be important because of the fact that if consensus is incorrect and say we get a higher reading like 3.7, 3.8, we know the Fed's going to be watching it. Maybe the market has to price in that they're going to do another rate hike, which as of now, in September, there's like a 95% chance that they're just going to hold rates where they are. So that's the market telling us, getting what it wants right now is keeping rates where they're at. But it's really important to pay attention to what the next meeting will say, as we might get some guidance. Now, if I take a look just at the raw chart, right, we'll look at the NASDAQ composite, a broad market, and there's a couple of ways to interpret this chart. I'm going to do it from a both bearish and bullish perspective. If I were to draw a trend like this, okay, you see a connection here, and a connection here. So that says, hey, it's acting as resistance there. So if we break past it, that could be potentially good for the bulls. And then I can draw in a couple other elements. Oh, you have a potential little shoulder right here, you have a head right here, and you potentially have a right shoulder right over here building out. So if price gets back above all of these EMAs, which is the 5, 10, and 20 EMA, it could be beneficial to watch for a potential breakout to play to the previous swing high and potentially higher. Okay, that would be the bullish case. Now, from a bearish perspective, take a look here at this trend going up, and then also you have this, which could look like a bearish type flag. And price, as it stands right now, going into a volatility event, we're below the 20, we're below the 10, we're below the 5. However, those EMAs, they're very coiled together, which tells me, hey, get ready. We're probably going to see some type of an expansionary move in the very near future to create the next trend. Okay, and what does that mean? What does that look like? We'll take a look what happens when we create an explosive move from a coiled area. Boom, prices go up. You have the 5 above the 10, above the 20. However, when they coil up, boom, you can also go to the downside where the 5 is below the 10, which is below the 20, and you could trend down. So we're right in that range to see a explosive move. If I look at the SPX, it's a very similar situation, right? We have a potential for a bearish flag type breakdown where we can head down. And by the way, if that happens, other people are going to say, see the head and shoulders pattern, it's still, potentially there. Boom, 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 breaks down. We go retest this area. More than possible for that to happen. Okay, but also on the flip side of that, if the market likes what it sees, we start getting back above this very coiled area over here, we may see an explosive move back up to try to break this trend line currently, and we can go to try to target the prior swing high in 2023. Now, the NASDAQ Composite Summation Index, the NASDAQ McClellan Summation Index, just recently ticked over, identifying a potential change in trend from a bearish perspective, right? And navigated the bullish potential change in trend. We saw a nice pop up, but we started to see it back off a little bit, and we said, hey, careful here. Could see some fish hooks or some sideways moves. So this just identified a potential change in trend, meaning that, hey, don't be too surprised if this starts going down. So be careful there. If I take a look at the 15-minute chart, I want to point out that the 5-day moving average is still declining here, but it's kind of, amongst a lot of different areas of confluence, meaning we're next to the month-to-date anchored VWAP, we're next to the quarter-date and week-to-date, and the price is right below it. So from this perspective, I am looking at this trend line right here. We want to get back above this area to be more bullish as it stands. We want to get above the week-to-date, month-to-date, and quarter-to-date, and the 5-day, right? On this right here, this little pop, this was a good little pop during the Apple event, but it started fading intraday. And as you note, right, price was going up. What was the 5-day moving average doing? It was still declining. So when it's declining and price is above it, that means you're bullish, but with caution. You're bullish, but with caution. And if you're below the declining, right, that's bearish, right, because you're following the trend. However, what you need to see to be bullish and to have it be not cautious, you want to see this start to flatten out and turn up. So it gives you an idea visually that the trend is moving up, the 5-day move is moving up, and you want to see a series of higher highs and higher lows moving forward. Okay, if we start breaking down tomorrow, right, look at those lower daily expected moves, potentially even the lower weekly expected move. But as it stands right now, we're just in a sideways chop consolidation near a lot of key levels. And, to feel better from a bullish perspective, we want to get back above these levels over here. And you want the 5-day to start flattening out to turning back up again. That would make me feel a whole lot more confident from the bullish perspective. And then if it breaks back down, well, then be careful. One other key level to basically pay attention to is see this upper daily expected move right here. Take a look where that lines up with an area of confluence right around this gap fill too. So there's a lot of confluence from the upside. So just be aware, if we open up at this level, That, I mean, it's not necessarily a bad thing, but give the market some time to digest to see if these start curling back up, put on a daily VWAP, and then we might be able to play for a higher move to the upside. But remember, statistically speaking, 68% of the time, the market closes within here. So if the market consensus is correct with CPI, it could close within here. But if they're incorrect, start paying attention to the upper weekly and lower weekly or these 2 sigma levels. That's all I got for you, everybody. Hope it helps out. See ya.